Welcome to this Killik Explains finance video. This week, how backtesting, as it's called, can bamboozle investors. So here we go. What is the problem essentially? Well, in a nutshell, let's say somebody's about to launch a smart beta or factor exchange traded fund. All right, a passive fund that claims it's got this clever strategy and it's going to follow it and you're going to reap the rewards. Now, this is a new strategy. So basically, there may not be any past performance data. This thing is being launched now. So one way to market it is to backtest it, if you like, is to basically say, well, what if this strategy had been followed 5 years ago with a product like this on an index we've just created? How would it look? How would it have done? And you as an investor can assume, is the implication, that that might continue in the future. So backtests try to show what would have happened had this thing existed, despite the fact it didn't. Now, Ben Carson, a wealth of common sense, has this to say about backtesting. Most backtests work better on a spreadsheet than in the real world. The theory sounds good because of competition, taxes, transaction costs, and crucially, the fact you cannot backtest your emotions as an investor. So let's take a look at this. Let's break it down and see what's wrong potentially with this backtesting idea. So the backtesting theory, first of all, is this in summary. There are lies, damn lies, and then there are statistics, and then I might add, there are dubious backtests. So new products don't have past performance data. The marketing teams will create some over a pre-launch period. 5 years is quite typical. And say, well, had this thing existed, it would have performed like this. Therefore, almost the implication is it did perform like this, and therefore it will continue. And that's how they're trying to hook you. Now, what can go wrong? Theory sounds good. Well, why are backtests not more reliable than actually they are? And I'll explain what I mean by that in a moment. Well, you're looking at an up-to-date model for a start. The past is not a guarantee of the future, right? You're looking at something built on previous circumstances. New funds will tend to pick strategies that worked in the past. So by definition, you're being marketed something that might have worked in the past with no guarantee it will continue working in the future. They're not going to sell you a pup after all, or try to. And it invites data mining. It invites the person doing the backtesting to be a bit selective about the period they pick, about the data that's input, all right, about the index they choose to make their point, survivor bias, let's forget about things that didn't work out over that period, and make sort of spurious correlations as they go. So there are all sorts of reasons why what can be solid looking backtested data is in fact a bit dodgy. Now, the evidence for this then. Well, there are quite a few studies been done, but Research Associates did a good one recently. They've looked at 125 different indices supporting smart beta or factor investing strategies. All form the basis of these strategies, and the outperformance, not surprisingly, was strong, but would have been, if you like, 3 years prior to launch. So had we been doing this 3 years ago, here's how it would look up to the present date. But 60 months after launch, most were giving S&P baseline performance. In other words, before, it all looks great, then afterwards, these things are just wobbling around a little bit above or even a little bit below the S&P 500, the spider if you like, and frankly, you are therefore being charged for performance that wasn't being delivered or hasn't been delivered since launch. And that's the danger. Now, why is this happening? Well, in a nutshell, 3 factors to sort of distill it down work against backtested success being necessarily repeated. 1, mean reversion. No single strategy outperforms forever. So yeah, sure, there might have been an advantage to employing this strategy 5 years ago, even 3 years ago, but people catch up, people work out what you're up to, they copy you, the advantage narrows, it disappears. Investors are lazy. People like to see a success story. They like to think, well, if I buy that, it will carry on. But maybe you're being invited to the party a little bit later than other people. So don't be lazy, do your homework, in other words. And conditions change, and strategies need to adapt to them. Simply put, we can't all be Warren Buffett, for example, the legendary US investor. What worked for him in the early days is no longer available now, even to him. Conclusion, therefore, what do you take away from all this? Well, don't believe the backtests, or certainly don't just follow them blind and go, well, it must be so, it's on a spreadsheet, it's official looking numbers, so I can just trust that. No. Analyze the factors on which your strategy is built. In other words, do some homework, all right? Next, challenge the marketing. Have conditions changed? Do you think, logically, these factors can still work in today's changed market conditions? and how many other products are chasing the same space. As a rough rule of thumb, the more people chasing the same space with the more magnificent looking backdated data, the more careful and selective you've got to be. Any questions on what is a big topic? Editor@killik.com. And if you'd like to see videos covering things like factor ETFs, indices and so on, please go to our library, killik.com/learn, and I'd suggest you start with the funds section.